Welcome to Real Talk with Real Estate Pros, where we bring you exclusive interviews with the real estate experts. We'll delve deep into their journey to success and learn how to go the extra mile to serve their clients' wants and needs. Let's dive in. Here's your host, John Money McKinley.
Oh, well, shoot, I just got a nice little notice from my producer in the back. He said, "Hey, dummy, you got to turn off your mute." So I apologize. Thank everyone. That was a great opening monologue I just did that nobody heard. But once again, welcome back to another edition of Real Talk with Real Estate Pros. I am John Money McKinley, and I wanted to thank you all for being here today. And do me a favor, please. We are trying to grow this show and really get it out there to keep people up to date on what's happening in the world of mortgages, credit, finances, and real estate. Do me a favor. Share this with your friends that are looking at doing something in the world of real estate. Have them like and subscribe. And as always, we're looking for guests to get on the show who are experts and real estate experts. Have them reach out to me. You've got my contact information is in all the description. I'll pin it in the first comment as well as you'll see it here periodically through the show. My direct text number, shoot me a text with their name and contact information. I'd love to chat with them and see about getting them as a guest on the show. But if you live anywhere around the North Houston right now, the Woodlands, Conroe, Willis area, you've probably been hearing 10 different stories about real estate and development and what's happening. You know, you got one headline that says rates are finally dropping again. I know Trump was on the television yesterday. He was talking about the rates are down and real estate's going gangbusters. And then you look at another news channel and they tell you that the housing is unaffordable. Then you see something about record credit debt, medical bills coming off the credit, on the credit. Who knows? Meanwhile, real life is happening. You're trying to figure it out. Can I actually afford to buy a home right now, or should I keep renting? Is it smarter to stay? If you already own a home, is it smarter to stay in the home you're in and just look at doing a remodel? Is my credit helping me, or is it quietly working against me? Well, up here on the north side, we're seeing more homes hit the market, new communities breaking ground, and investors building entire neighborhoods just to rent them out. And I'm sure, depending on where you're at in the Houston and surrounding area, you've been seeing a lot of those as well. At the same time, a lot of families are feeling the squeeze from higher prices, higher card balances, and surprising bills popping up. Matter of fact, my guest who's on the show today is the credit expert, Greg West, and him and I in the green room before we came on the air today, we're talking about just how much everything seems to have gone up versus what it was 6, 7, 8 years ago. And what I'd like to do is go ahead and bring Mr. West on right now, and we're going to really dive in and give you guys a much better idea and understanding of what is happening in the world of real estate, finances, and credit. Mr. West, how are you doing on this fine, wonderful morning?
Pretty good, bud. Glad to be back.
How are things in your part of the world, sir? You're over there. Greg's hidden in the mountains of Kentucky, where he keeps the credit secrets safe and hidden from the evil empire that is trying to get at him and put him out of his misery to stop him from educating you on how credit really works.
Yeah, just finally thawing out from the below zero for like 2-3 weeks. kids that didn't go to school for 2 solid weeks. It was ridiculous. But anyway, we're finally back in the normal temperatures.
Oh my gosh, you guys were getting killed. I know a lot of people were hit hard by that nice
Yeah.
snowstorm that blew across the country.
Mm-hmm.
Well, with that said, Mr. West, are you ready to dive in what's happening in the world? Because this is the last Wednesday of the month, and Greg and I always like to come on here and put together this show so we can give you guys, I call it the monthly news update on what's happening in the world of real estate.
Yep. Let's do it.
All righty, let me go ahead and pull up our first news story here, everyone. This talks about mortgage rates today, February 23rd, 2026. 30-year rates fell to 6.07%, according to this article, not according to me. Mortgage rates are down Friday and remain under 7%. That is true. That's what I've been seeing on my side of things. Today's national average, and please keep in mind when these articles talk about the national average, they're grabbing a snapshot of mortgage rates all over the country from multiple different lenders on different days of the week. And that's something I'd like to stress to everyone. What the interest rates are right now may not be the same thing that we could see at 3 o'clock this afternoon. The mortgage market moves, and sometimes it moves very, very rapidly. And Greg and I have done shows about this in the past as well, and we'll continue as this year progresses on to dive back into that and really dig into what really has an effect and control on what's happening in the world of interest rates. But this here's talking about because the labor market is holding up and inflation remains elevated, mortgage rates might drop much in the near term. Minutes from the January Federal Reserve meeting, which released on Wednesday, suggested that central banks are unlikely to lower federal rates until they see more progress on inflation. And I don't know about you, Greg. Does that inflation seem to be bothering you when you go to, I don't know, the grocery store?
Oh, yeah. Yeah, I don't know where these people get their. It's almost like they're flat out lying to people. Now, of course, the inflation rates they're talking about is year over year from the previous month or whatever. But one of the biggest lagging indicators in that when they do that inflation stuff is housing. And housing's a lagging indicator, which has been going down for about a year and a half, but it's not caught up to when they give us the alleged inflation rates. But man, I don't know. The numbers are what they are. Believe them, don't believe them. I mean, you have no way to verify what's accurate, what isn't. But in real life, yeah, stuff's going up. There's no doubt about that.
And we are in times where it's more important than ever to know what every dollar's doing. Know what every quarter's doing. And I know quarters, people are like, what's quarters? Well, back in the good old days, Greg, you remember the ancient days? You could put a quarter in the telephone. You could even put it in a pinball machine.
Yeah, I remember when it was a dime for a phone, actually. But yeah.
Oh, well, you're ancient.
I'm up there.
I remember when pinball games were only a quarter. Now they're like $1.50. I was like, oh Lord, that's expensive. I was in North Carolina last year, around this time last year, and my friend, we went out and nice place, had a couple beers and playing some pinball. Like $1.50 a game. I'm like, holy smoke! But back to the news stories, Greg.
Yeah, reel you back in, buddy.
Exactly. I apologize. I didn't mean to go off on a tantrum on inflation. The Consumer Department reported on Friday that Core Personal Consumption Expenditure Price Index, which is the Fed's preferred inflation gauge, rose 3% year over year in December up from 2.8% in November. Fortunately for borrowers, rates are down substantially from earlier 2025 when they topped over 7%. Housing market contributors are also beginning to favor buyers. So if your home buying plans are on pause, were on pause last year due to the high rates, 2026 might be the year to jump back into the market. And we're seeing a lot of that from where I'm at, the perspective I've been seeing lately. I have been seeing a lot more activity, and I have been seeing a lot of things really peak up with buyers just because we've started to see inventory rise. We've seen the interest rates come down a little bit. We've also seen more there's a lot more homes available. There's new construction still going on to this day. How much longer will we continue to see that? I don't know about that.
Yeah. I'm pretty sure that all-time construction quits are close to all-time highs back to where it's 2008. So there's a lot of them that are kind of stopping. But yeah, of course, up here in Richmond, Kentucky, man, they're building the crap everywhere. So who knows? Depends on your area, I guess.
Yeah, I mean, there's been a lot of things moving, and we saw a lot of activity last year and the year before that with a lot of people moving where they were living at, and moving out of certain states that where the cost of living was just becoming unaffordable for people, and they simply
Mm-hmm.
decided to pack up and move to other states. I know Texas has been doing very well. Florida's been doing very well. I also know North Carolina has also been doing very well as well. I mean, there's a lot of activity going on. And back to my area of the world, the Woodlands housing market sees rising prices and inventory in January. The January 2026 housing data for the Woodlands reveals a market that is gaining inventory, experiencing longer selling times, and continuing to see price appreciation. Whether you're considering buying, selling, or leasing, understanding these trends can help you make a more informed real estate decision in today's evolving environment. And here's a closer look at the insights for the local market. Inventory surges 30% year over year. We've got active listings here in the Woodlands area climbed to 354 homes in January 2026, up from 273 homes in January 2025, a significant 30% increase. And that is something to keep in mind as well, that I want to make sure everybody understands this, is a healthy real estate market. You really want to see time on market. About 2.5 to 6.5 months is considered a healthy real estate market. Now, when we had the pandemic going on and we had the interest rates down in the 2 and 3% ranges, that was not a healthy market. I mean, Greg, you remember that even in Kentucky, people were buying home. They would put the sign in the front yard and somebody was already under contract the next day, wasn't it, Greg?
Yeah. It was a lot of stuff went quick.
Yeah. And we saw the same thing here. I mean, in the Woodlands here, not too long ago, realtors didn't even have to put a sign in the front yard because all they had to do was just put it on the MLS. And if anyone would like to know what MLS means, it stands for Multiple Listing Services. That's the tool realtors use to list their properties where you can go on and easily access the homes. But that is an unhealthy market. Just like when we have a market where homes are sitting on the market for 12 months, 14 months, 18 months, that is just as unhealthy. We are starting to, the field is leveling out. And it's the rubber band effect. When you pull the rubber band one way to one extreme, and it goes back, it starts rebounding the other direction, and then it finally starts leveling out. And that always has happened in the world of real estate. I mean, it wasn't too long ago, Greg. Do you remember the great 2005s
Oh yeah.
and 2006s?
Mm-hmm.
The good old days of the mortgage world, sir?
I do.
Lending was easy. Banks wanted to
Yeah.
give you money. You just showed up and said, "Hey, I got a little bit of credit and I'm breathing." Now
Yep.
we did,
Heartbeat and something else. I can't remember the joke we had back in the day, but yeah, that was it.
Greg. We all us loan officers carried mirrors. We had to put it up to your face and say, "Breathe." And if it fogged up, we got a loan for you. No money down, we're good. 570 credit score, don't worry about it.
125% loan to more value. Yeah,
No, we
there's all kinds of crazy
cannot
stuff.
do that in Texas, sir. Texas
Well,
has very strict laws on loan to value, which a lot of people can be very thankful of that. I know I have
mm-hmm.
sometimes I have to get into a deep conversation with folks when they want to get some equity out of their home. Well, what do you mean I can't take more out than that? Who says? Well, the state of Texas says.
Yeah. Wasn't that one of the changes after 2008?
No.
Or did they always do that?
No, Texas has always been that way.
Oh, yeah.
When I first got started in the business, you couldn't take equity out of your home in Texas. Yeah, that didn't start till the early 2000s. And I remember people, they would call the office I was working for, and they were so excited because I could get them a cash out refinance to help them pay out of debt. And I was getting them lower interest rates than they had. They were ecstatic about it. So it was very nice. But with that said, it was a healthy market we were in for a short period of time.
Yeah. Yeah.
And then back to what's happening here in the Woodlands, we're looking at about a 3.6 month of inventory. Supplies increased 20% from 3 months last year, signaling a shift toward a more balanced market. Home prices continue to rise. Medium sales prices in the Woodlands are $602,500. Medium sales price in January of 2025 was just a meager $551,250. 9% increase in a year. Now, when I first got started in the world of real estate, Greg, 3% was considered a good rise in appreciation. If you got 5%, you were doing good. So we've had quite a move in the appreciation of homes. And I think this year the Woodlands is kind of a unique area that's always in high demand. So we're probably going to stay here a little more on the higher end of appreciation versus some of the other areas. And then we start balancing out, probably getting around the 5%, 6% appreciation annually, which is a good average appreciation rate. And here's another article. The Woodlands housing market. The Woodlands housing market is somewhat competitive. Homes in the Woodlands received 1 offers on average and sell in around 49 days. The median sales price of a home in the Woodlands, once again, the 604, up 9%. The median sales price per square foot is $214. That's up 2.1% since last year. And then we can go back and see this trend. Ooh, that would have been a good time to buy a home here. Back in 2023, was almost down to 400,000, and then we've seen some dips, but we've mainly been on a very nice, steady move up. So, and we go over to here, and here's something that I think people will find interesting is a little bit further north. If people are looking for a more affordable area to live, yet still be somewhat close to the Woodlands and the amenities that are in the Woodlands, and this is from RE/MAX. This is back in this is in February 19, 2026. we're taking a look at Willis. Willis, Texas has really had a lot of stuff going on. Mid-month in Willis brings another snapshot of how property values, inventory, and buyer activity interact in February 2026. If you're making a move, the latest figures create a big advance over those relying only on year-end summaries. The median estimated home value remains at $311,550, and this is in the Willis area, which is a much more affordable price range than here in the Woodlands. Well, selling prices are up at $299,999 or $990, and list prices keeps it steady at $324,990. A 6-month inventory supply ensures options and stable turnover. Affordable homes in Willis, Texas, this February 26 are within reach for buyers who study listing details and align bids accordingly. And then they have here the medium estimated value $311, medium sold price, medium list price, and months inventory 6.19. That is another good, healthy indicator that, hey, there's about 6 months worth of inventory, which is very, very, very healthy. And last but not least, before we get into your side of things, I'd like to get into this here. This is something that I know a lot of people are starting to see. A company called NHK Capital opens Houston BTR community. Investment in the project totaled nearly $28 million. NKH Capital Partners has opened Solantra Rolling Pines, a 109-unit BTR community in Conroe, Texas. The development projected totaling $27.8 million. Excelsior Partners, wonder if that has anything to do with Marvel Comics. Served
Don't
as
know.
Yeah, it could be. You never know. There's a guy at part of Marvel not too long ago. He's passed away, but he liked that Excelsior saying. Served as a development partner while HS Development acted as the contractor. Property management is managing the community previously known as Edge at Conroe. Rolling Pines 1 to 3 bedroom townhome floor plans averaging 1,300 square feet. All units encompass washers, dryers, fenced backyards, while some also featuring wine coolers and attached garages. So now you can get a rental home with a wine cooler, Greg. I mean, because
Not one of my interests, but yeah.
I'm just saying, you got to have the wine cooler if you want to live the proper lifestyle. You understand that, right, Greg?
Sure.
Property 2400 Montgomery Park Boulevard, which Montgomery is another area which is really doing well here in the northern part of the Houston area. Close to several dining options while retail chains, Walmart, Supercenter, Aldi are within a mile radius. Common amenities, pet friendly. This is another thing we're starting to see a lot of as well, is these developers are now going out and they are developing these communities that are basically subdivisions that are all rental. And they started this a while back. They were going into new build construction areas, and they would go in and they would almost buy up the whole community. And there's one that's not too far from my house, and I feel bad for the people that bought homes in there. But for every one home buyer, there's 9 homes that are bought up by an investment group. So you've got a whole and they're still building homes there. You still got a whole you got a whole subdivision that is nothing but rentals for the most part.
Yeah, that goes along with the ultimate goal at some point. You know it.
Oh, I know it. You'll own nothing and be happy.
Yeah, just boiling frog process.
Exactly. Well, now let's take a look at something that we are both very familiar with. And this is from the nice folks at the CFPB, Central Financial Protection Bureau, for people that would like to know what their name means. And this is
Mm-hmm.
dated January 7th, 2025. The final rule will remove billions of dollars of medical bills from credit reports and debt collection practices that weaponize the credit reporting system. Those bastards.
Yeah, yeah. We talked about this a few times last year, and I was like, well, I'll believe it when I see it. I think I am seeing it. Um, I do see a lot less medical debt on reports than I used to, so I'm assuming that is come to fruition. The weird part about it for me is the Consumer Financial Protection Bureau. Allegedly, they were shut down by Doge last year, so I'm not sure why they're still doing stuff, or if maybe they got reinstated and no one knows about it. I don't know. The whole thing's weird, but it looks like that's coming to fruition. That's good to not have it on people's reports. You shouldn't be penalized for your health, how you pay your, especially with the way they bill people. You get 10 bills for one visit from all kinds of different directions. But yeah, it looks like that's a good thing.
Yeah. And just so people know, is the CFPB shut down? Yes and no. It's not really, it's kind of like this way to think of it is. Just because the police are not out and active doesn't mean the laws aren't still in place.
Correct.
And look, I know there are some out there. I don't want to name any names. I don't want to start any conspiracies here, but there are some that are being a little more looser than, in my opinion, they should be, because just because the police aren't there, the police will come back eventually.
Yeah.
And when they do, in my opinion, we're definitely we're gonna see some people not being very happy, or should I say, some companies not being very happy when the hammer does come back down. And trust me, that CFPB does have a big stick and a big hammer. So
yeah, they'll be back.
Yeah, that's why I'm there's the rules, and that's the rules I'm following. That's what I'm going with. Until they change it, I'm not quitting. I don't care if there's not a cop there at the stop sign. I'm stopping. And then we've got another article here. This is on credit card debt, which I know you see a lot of this with your folks you work with, Greg. You want to dig into this a little bit, please?
Yeah, I mean, we've talked about this a lot too, but it always helps for any new viewers or whatever. But it's with everything that's going on, people, that's what they're doing is they're charging their cards. And I'd probably say at least half of those, when I try to get them ready for home purchases or whatnot, that the recommendation is to pay down the cards. You got to do way more than just make the monthly payment. And this article goes on to say 20 to 30% is where they like to see at, meaning if you have $1,000 limit, they don't like it to be over $200-300 of what you owe on the card. When you go above that, it says it damages the credit. But I know firsthand that it's once you hit 10%, you start taking a lick. Just from personal experience in the past, I had a 40-point drop once, going from 8% utilization to 22. So once you cross 10, 20, you're taking a hit. And what I mean by that, if you're in like close to 8, you'll be down in the mid 7s. You get up to 80-90%, you're going to be down in the low 600s with your credit cards, because it's 30% of the score. So it's huge. So you got to do the best you can to pay it down. Plan ahead, especially with a mortgage, because with the new trending models, they're going to be able to see your, I think, 2 years worth of history now they look back on with how you pay your bills.
Yeah.
So the sooner you get under control, the better.
And I feel that we're going to see more of that trending model as we move forward. And
FICO 10T, for those that haven't watched our previous shows, it's a new model that's been put out.
Yeah. And look, it makes sense from the standpoint of the way the people with the gold, and we all know he who has the gold makes the rules, right?
Yeah.
So, I mean, when you look at it from their standpoint, the trending model makes sense for them. Why? Because time and time again, I'm able to help people, and this is where it's going to hurt people. I have a lot of folks that have $500 credit limits, $1,000 credit limits on their cards. Well, they owe $600 on a card, $400 on a card. It's not a lot of money, but because their credit limit's not that high, it's crushing their credit scores. And when I do my consultation with them and we sit down, I bring them into my office and we go over their game plan, their home buying game plan, and I show them, pay this down, pay this down, pay this down. Now we can take your score from here and potentially get it up to here, which leads to a much better interest rate, because that's one of the big factors that factors into your interest rate. It's not the only factor, but it is a very, very big factor. Well, if the trending model takes over, paying that down is not going to have the big effect like it does now, where I can take somebody, and you and I have done this time and time again with clients. We evaluate the credit, take a look at it, and go, hey, pay this down. You should probably be able to go to at least 680, maybe even 700. Well, that is a massive, massive improvement in your interest rate pricing. And if you take that away, then, are you there?
I'm still here. I think the internet's acting a little sketchy.
Uh-oh, don't lose me, Greg.
I hear you.
Well, see,
we're gone. It was nice seeing everybody.
Well, we were. Well, the problem was, see, we were talking about stuff that maybe they don't want you to know. That could be it, Greg. And now we're going to dive in a little more to household debt balances grow modestly. Early delinquencies level out for non-housing debts. This is February 10th, 2026. The New York Federal Reserve Bank and New York Center for Microeconomic Data today issued its quarterly report on household debt and credit. The report shows total household debt increased by $191 billion. It's 1% in Q4 of 2025 to $18.8 trillion. That's a dramatic difference, wouldn't you say, Greg?
It is. It is. That's most people are getting by on their credit cards. The headline was kind of a easy wording, but basically the non-housing debt is for the most part credit card and vehicles. But yeah,
and it's here mortgage.
But I can see why. It's rough out there. It'll get better, but it's rough right now.
Mortgage balances grew by $98 billion in the fourth quarter and totaled $13.17 trillion at the end of 2025. Credit card balances rose by $44 billion and stood at $1.28 trillion. Auto loan balances increased by $12 billion to $1.67 trillion after holding steady during the prior quarter. Home equity lines of credit, HELOCs, balances increased by $11.6 billion to $434 billion, while student loan balances rose $11 billion to $1.66 trillion. I guess those balances have risen because there were a lot of people that got a promise. I won't mention any names by who, but we're told that you ain't got to pay that student debt. It's all good. It's all good. And there were no payments, nobody having to count any debt against you. And, well, that kind of went away. So I guess all those fees for all the time they didn't have to pay are probably starting to catch up a little bit. Would you say, Greg?
Yeah, that, and a lot of them weren't informed that the payments were supposed to be started again. So we had a lot of people got hit with some late payments that were unaware. But we talked about that last year as well. But yeah, it's.
I had multiple.
I'm not going to get into
it. I had multiple clients, and that's something else, and that's why it's important. That's why I'm glad you come on here every month, Greg, to talk with me, to talk with everybody about credit. You got to know what's going on in your world of credit, because I can't tell you how many people that I worked with last year that were coming to me to get a home, and we're going over stuff, and I'm going, look, well, yeah, I got behind because nobody let me know the payments had started up again. Nothing in the mail, no phone call, nothing.
Yeah.
And then I found out, and you can see I immediately paid for it. I'm like, that's fantastic. That's good. However, this 90-day late has tanked your credit score.
Yep. Got to stay on top of it. And a lot of these topics aren't comfortable to talk about, but they have to be. You got to know what's going on, or it'll bite you later.
Yeah, you've gotta watch yourself, and that's something I want to stress to everybody. Look, there's nobody gonna come in and watch out for you and take care of you. And we know today there is so much distractions going on. There are so many things going on that's trying to pull your attention here, trying to pull your attention there. Oh wait, you got to look over here. No, wait, there's this thing to look at. There's this shiny thing to look at. Look at what's happening in your life. Pay attention to you, your life, and your circle that's closely around you to keep yourself in a position to where you can keep doing the little things to improve yourself and improve the people you come in direct contact with. And I know there's crazy stuff going on in the world today. And one of the things
Yep.
I tell people
Oh,
is,
well,
look,
you can hear me. Oh, I froze.
oh, did I lose you?
We're about yourself.
E-
Oh, my
ex-
internet. I just got a notice. It's unstable. I don't know, kidding.
Yeah.
All right, let's get going.
Yeah, you got to
I don't
worry about yourself. And look, people go, "Oh
Yeah.
my God, that sounds so selfish." No, if you take
Yeah.
care of yourself, you can offer so much more to help out other people when they need a helping hand.
Exactly. Yeah.
Well, let's go to this last thing, and this is another thing we've touched on briefly before, but CFPB, that's them again, agrees to eliminate the $8 cap on credit card late fees. I find this kind of strange, Greg, that April 15, 2025, the U.S. District Court in the Northern District of Texas vacated a consumer financial, or the CFPB rule that capped the credit card late fees at $8. This decision granted a joint motion brought by the CFPB and coalition of trade associations that had sued it, which sought a consent judgment reflecting the parties' settlement of the case. I'm trying to understand why this would be overturned when this is really helping to protect the consumer with the cap on this.
Well, you got obviously the people that went against it were the credit card companies. But I got to tell you what, you're probably going to be surprised at my response to this, because this goes along with also where they're trying to, I think they're talking about doing now, trying to cap interest rates on credit cards and stuff too. It seems like a good thing for some people, and it could, but I think free markets need to work this out. Because here's my thoughts on that. When you go getting the gov, making what companies can and can't do, say they lower it to where you can't have more than 10%, I think is what they're talking about doing on credit cards. Well, that's all well and good, but higher risk, and they're going to charge 20, 30%. So if you get rid of that, I think it's going to stifle a lot of people's ability to actually get credit, in my opinion. I mean, that's the other side of it. So you could make arguments for both ways, but I think if you let just free markets work it out. Like I know credit unions, you can usually get better rates on your credit cards. Go there if you want a better rate instead of everybody forcing everybody to do the same thing. I don't know, but that's my thoughts on it. I think you're going to stifle people's ability to get lending.
Yeah. And we're gonna see a lot more continued changes. And like I said, the CFPB is it's still there, but it's not there right now. And it's going to be real interesting to see when we get through this push. And like we were talking earlier, this year may be a tight year. Just if you're struggling now, if things aren't working exactly like you want them to, just try to keep your head focused in as much as you can. Take care of you and your family. Take care of what you need to take care of to survive. I think we're going to start seeing some more balancing out as the year moves on. I think we're going to start seeing some prices come down a little bit. I know we were talking at the beginning of the show how expensive things are, but we are starting to notice some price dropping and some things at the grocery store, and hopefully we'll continue to see more. And we've seen a little bit of dipping down in gas prices too. I know the other week I got gas for less than $2 a gallon. I was quick to get to the gas station and go, it's time for a fill up.
Yeah. Well, I'm not a doom and gloomer guy. I never have been, but you got to state the facts that are out there. And yeah, but it is, I think it's starting to turn as far as investment wise. A lot of people are getting risk off, which means they're going to be buying bonds, which should lower rates at some point during this year. Again, that's just me saying, I'm not a financial advisor, just letting people know that's how it works. And yeah, I think by the end of this year, things are going to turn around. And so keep your head up, stay focused, get your stuff paid. You'll be all right.
Yeah. Well, with that said, Greg, we are coming to an end of another great show. And do me a favor, tell the people if they want to talk with you about what's happening in the world of credit and have an expert like yourself give them a consultation to sit down and analyze what's happening with their credit and what they can do to put themselves in a better position. How can they reach you, Greg?
I know this is going to sound strange, but the best thing to do is call me.
Whoa, 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 whoa. You mean
I
like
know.
with the telephone?
Yes. And you dial 859-625-4546. And here's the other strange part. If I don't answer, it's because I'm usually on another call, leave a voicemail. I will call you back.
Whoa, whoa, whoa,
That's the
whoa.
best way to communicate information is through verbal.
You mean that thing that gives you a message and then says beep and you put your name and phone number and to ask them to call you back? You actually check that?
I do, yes.
That's crazy, Greg. I heard that stopped being done in like what, the 80s?
Correct.
Perfect.
That's the best way. I mean, I've got a website at westcreditservices.com. If you want to send the best time to call you, I can call you. But yeah, don't be hesitant. Don't be hesitant to call me.
Perfect. Well, let me put you back in the green room, Greg. I'm going to say goodbye to the audience, and I will be back with you in just a moment, Greg. With that said, everyone, thank you for coming to another edition of Real Talk with Real Estate Pros. You guys have a fantastic day, and like I said, do me a favor, like, subscribe, and share. And if you know somebody that you think would be a great guest on the show, please reach out to me. All the contact information will be pinned in the first comment in this show, and reach out to me. I'd love to talk with them and possibly have them as a guest on the show. Y'all have a great day, and we will see you here next week.